Good morning. I'm coming to you today to share some open and honest insight about what our economy is going through. As we face a global pandemic that threatens our families, communities, and economic well being, we are facing an unprecedented time that is filled with uncertainty. Above all else, our concerns are with anyone who has been impacted by the virus, and our hearts go out to all of those that are fighting for their health, and we wish them a full recovery. We also extend our deepest gratitude and support to all of the first responders and all of the healthcare professionals who are risking their lives to help our community and all of the communities around the globe get through this extremely challenging time. Currently, the market is in panic or chaos mode, and I feel it's important to educate you on where we are. The first item I wanted to address is that what's going on with the market and the rates, because there are definitely some misconceptions about where the rates are right now. So on Sunday night, the Fed lowered the Fed funds rate to 0%. So what does that mean? This does not mean that mortgages are now 0% like some believe. So the Fed funds rate has been almost 0% before. In fact, from 2009 to 2015, it was almost 0% the entire time. Mortgage rates were not 0% then, nor are they now. So the Fed funds rate pertains to the overnight lending rate to banks. So think more in terms of HELOCs and credit cards. So lowering this rate makes it easier for banks to borrow money between each other and the Fed to keep balance sheets healthy, basically. So this is done to protect our economy in case people panic and decide they want to take their money out of the bank. Banks do not have all of that money liquid and would be unable to give all of their depositors their money. Banks rely on that money to be able to lend, and banks are usually able to lend up to 90% of what they have in deposits and are required to keep 10% as a reserve or cushion. So the Fed actually just removed that 10% requirement, allowing banks to lend more of the money they have on deposit. In the event banks got a large number of people wanting to withdraw their money, then they would now be able to borrow the money from other banks or the Fed at the new Fed funds rate. So basically what the Fed did was they injected liquidity into the market by lowering the Fed funds rate to be proactive in our current economic and financial climate. So the Fed funds rate does not directly impact mortgage rates, but what does impact rates is the mortgage bond market. If the price of the mortgage bond goes up, the yield or interest rate goes down. And if the price of the mortgage bond goes down, then the yield or the interest rate goes up. So the bond market affects interest rates, but what we are also dealing with is a supply and demand issue. We have supply and demand constraints. Banks have raised rates now just to stop the new loans coming in. Mortgage banks are all basically at capacity because so many loans came in such a short amount of time, they don't even know how they're going to close them all. They don't want any new loans because they can't handle anymore. Many banks have stopped allowing refinances altogether just so they can set aside capacity for the purchase business. So it's a supply and demand issue, like I said, and there's about 5 times the amount of people who could have benefited from a refinance than what the mortgage industry had capacity for. So consumers don't understand this, and they expect mortgage rates to be the lowest they ever have been, but the truth is rates today are higher than what they were this time last week. And the best rates or mortgage rates are basically being reserved right now for purchases. So the Fed funds rate does not directly impact mortgage rates, but the Fed is taking an action that is affecting mortgage rates, which is that the Fed announced that they will purchase $200 billion worth of mortgage bonds. So what this does is it pumps liquidity into the bond market because the Fed is agreeing to purchase bonds that no one else was wanting to buy. So without the bonds being purchased, banks would then be forced to service the loans themselves, and they would not have the capital to keep lending. So yes, if you looked at the mortgage bonds, they have rallied and had mostly bounced back from their drop late last week, but it's a very fluid situation and it's very up and down throughout the day. The capacity issue remains at play in the mortgage industry, leaving mortgage rates higher than what their all-time lows were just earlier this month. So there's also uncertainty with what the economic fallout is going to be with the effects of the coronavirus. This has and will likely to continue to play and have an impact on the market, as there's a high level of fear of job loss and companies going out of business and just what that's going to mean for us long term. So right now, it's a great time to initiate a conversation about potentially refinancing so that we are ready when the time is right. It's also a wonderful time to begin the planning process for purchasing your home, whether you're considering buying now or you want to buy sometime within the next year. So feel free to reach out to me with any questions you may have about your options or about what's going on in the market. And just know that I appreciate your patience and your trust while we navigate these unprecedented times. And I hope you and your family are staying safe. Talk to you soon.